answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. I think nuts.
With your host, Phil Grande.
Bye. Welcome to my podcast. Good afternoon. Well, today we got a couple of serious things to talk about. Before what happened with Trump's 15% global tariff shock, the market, the big institutions have been dumping billions and billions of dollars of stock. A lot of it's tech stock. Now, I think we should cover that first because that's important. Now, the reason they're dumping is because, remember, what fuels the stock market is liquidity. Now, when you think of liquidity, most people think, oh, dollars. No, liquidity is not cash sitting in some bank somewhere. Liquidity are channels. So think of it this way here. Bank reserves is a channel. Repo availability is a channel. Dealer balance is a channel. Margin finance. I mean, there's 6, 7 channels. That's where the money's at. So what fuels the stock market is that we have the access to go to those channels. And when that money comes out of the channels to the stock market, you want it nice and smooth. Just think of it as one big lake. A pool of money. And so you want all those channels that have all that money, that's one big pool of lake, you want that flowing nicely and steady to our stocks, to the stock market. Well, that's not happening because it gets interrupted. Now, what interrupts that money, when that flow of money, think of it as there's a big hose coming out of that lake of money, and all those entities are in that lake. When the money starts flowing out, all of a sudden the hose gets snagged for some reason. Money's not going through it. Well, what is the snag? Well, what's going on is causing the big institution to dump billions of dollars of stock, and especially tech stock, is because the policies, monetary policies. So they become choke points, snags. So again, Treasury issuance, use that's a good one, Treasury issuance. That sucked all the liquidity out of that system. When they did all these treasuries, and it pulled out all this liquidity out of that system, and when the Treasury floods the market with new bonds, buyers have to come up with cash. And where does that cash come from? Money markets, banks, funds, dealers, all of them pull money out of those things that create our lake of money. So because of that policy, they shut the money down. Now there was another policy, was the Fed balance sheet. That's another reason, another bad policy. We're still doing QT, we're doing tightening. We did QE, but now we're QT. They're trying to shrink the balance sheet. They've been doing that now for quite a while. And the problem is they keep doing it, and it's less leverage. So that also chokes and stops the money. So all these things, these policies, like the reserve repo, those repos, all that money in that facility is drained. It's drained. So there's no more, so we just don't have any more cash sloshing around for that. So when let's just take those three. So because of those three problems, the cash gets shut off, the liquidity gets shut off. So there's plenty of cash. There's plenty of cash. There's no problem with that. We have a lake big enough with all those entities They're filling it with cash, but we can't get the cash through the pipe or through the hose to our stocks. Now, is this temporary? Well, I would think so, because when you look at the credit spreads, they're still tight. So anytime you have the credit spread between your treasuries and the corporate, as long as it's less than 150, that's good. That's tight. We're at 75, I think, or 80. That's very, very tight. So the question comes, well, if this was as critical as Wall Street wants us to believe, and jibber jabbers want us to believe, they're doing that because they want to see a big sell-off so they can go in and buy stocks, key tech stocks, cheaper. Because something doesn't match here. Because normally when you have something like this, where the flow of money gets cut off, I mean, you've got to have something pretty serious. And what that is you've got to have the spread, it's got to be wide, not tight. So again, we're just going to have to wait, play it out, and see what happens. Because again, I've seen them play games like this before, and they make a big deal out of nothing because they want to drive those stocks down so the institutions can pick them up. So that's what's going on with that. So that's the one problem we're having. So again, what fuels the market is what you've got to look at. And people get confused with it because they say, oh, liquidity, they think dollars. No, it's not dollars. It's, again, the liquidity channel are these entities. And the bank reserves, repo, dealer balance sheets, all that stuff, margins. And so right now, what's happened is all these monetary policies, like, for example, the Fed is now trying to shrink their balance sheet. And that's caused now, it's gone so far, it's caused the pool of money that comes out of that lake. There's now a crink in we'll call it, for a better word, there's a snag in the pipe going to our tech stocks and all the other stocks. So what do you do? Well, the thing you want to do is you want to be prepared. So you keep watching the spreads. Make sure they stay narrow. If the spreads start going up from 75, 80 towards 150, then you know this is getting very serious and it's going to get worse. The big institutions will keep dumping and dumping and dumping, and the stocks that are going to get hurt are going to be the tech stocks. Let's go take a look. So, but don't make a mistake and start shorting the Qs, for example, immediately. That could be a mistake, especially if you've been in them for quite a while. Now, let me show you what I mean. So if you look at, let me put them up here for you, if I can find them. So let's just take the Qs. And this is interesting. So again, here's the Qs. This is the one that's getting clobbered. And you can see on my Pro 2 color-coded chart, if I bring it back even 6 months, you can see how the terrible pattern it's having. It's not a nice tight pattern. You want a nice tight pattern, like, for example, you want a tight pattern like this one here, Johnson & Johnson. See how nice and tight that pattern is? That's a tight pattern. You know everything's okay when you got a tight pattern like that. That's good news. Just going to keep going up. That's a footprint. That tells you institutional money is in there. When you look at the Qs and see this terrible footprint, it's telling you institutional money's not in there. And whatever institutional money is in there, they're dumping it right now. And then they're going to come in and short the hell out of this thing when it breaks the 200-day moving average. So the 200-day moving average, let me just give it to you. The 200-day moving average is around 582, if I'm correct. Around 583. And we're now at 599. So if it breaks there, then I get worried. But I wouldn't start selling short now when you're in between the 50 and the 200 day. And we also have, though, a nice trend, downtrend. Now remember what's trend. Everybody looks at the stochastic as a trend. No, it's pricing. The pricing's going down. The pricing's making a downward trend. So on the way down, don't cost average down. Don't do those things they tell you to do. Cost average down, buy in a dip. Don't do any of that. Your target is that 200-day moving average. If it breaks, the Qs break below that 200-day, then you short the hell out of it. If it breaks above the 50-day and it breaks above the high of, let's say, 637, that's when you buy the hell out of it. So you got a choice. You don't panic right now. All the panic that's in the air is created because they want you to dump your stocks so they drop and they come and pick up the best stocks for a lot less money. So it's interesting when most people just don't understand how the market works, okay? And also remember too, when you have these rising 10-year treasuries, okay, that the 10-year treasury yield, which we look at every morning when we start trading, that identifies credit spreads for the investment grade corporation bonds are widening, okay, are widening. So that means institutions are not buying stocks. So while we're going through this, make sure you look at your 10-year treasury yield and just identify the credit spread. And if they're widening, they're not buying stocks. But if the yields, okay, are getting narrow, I mean, when you get a good, narrow, tight spread, that's when you're okay. But when those credit spreads start widening, you're not okay. So again, if you go back and take a look at February, what happened? February, and this is the problem. Most people they trade, they don't even know what yields are. They don't even know what the bond market's about. You get truth from the bond market. You get truth from IWM, the small mid-cap stocks. That tells you how things are doing. Because IWM is the only ETF that identifies the health of the stock market and the economy. No other ETF does that. So let's just take a look at IWM for a moment. See how IWM is. IWM is wonderful because it tells you how healthy everything is. Now, if you look at IWM, it's right at that 50-day moving average. So if IWM drops through that 50-day moving average, and we have a problem with the Qs, all of a sudden that will drop let's say that drops the Qs below the 200-day moving average, and then you look and see what the credit spreads are, and the credit spreads, again, are starting to go from 80 to 150, now you've got a problem if they get above that. So there's three things you got to, the answer is this really going to come into a crash? Is this going to be a crash? Well, you don't have to guess at it. You'll know. Because if IWM breaks the 200-day moving average, and then you have the credit spreads, okay, starting to widen, just those two alone tell you, yeah, we're going to have a crash. Because as these things keep occurring, and as long as the money, we need that fuel. We need that fuel for the market. And and they've cut off that fuel right now because of the things I just talked about a few minutes ago, all the different things that stupid things they did, like these stupid policies, like tightening, right? QT. So that was a dumb policy. It's not working, right? It's now a choke point. And the Treasury, all the treasuries are issuing, it's spiking up. That sucked out all the liquidity out of the system. So between the policy of let's go and issue a bunch of treasuries and the Fed balance sheet, let's shrink it, and repo money, let's go in and do a lot of repo. They drained the repo money, they screwed the tightening, and now they're sitting there with the treasury spiking. That's sucking liquidity out. That means that what provides us the liquidity, those things we got to go to, they got plenty of money. But these stupid things, think of it as we can't get the money out of the money lake through the hose to the stock market because of all these stupid things they're doing in monetary policy. But again, don't overreact until you identify what's going on with your credit spread, what's going on with your IWM. If those get negative and the Qs drop, short the hell out of it. That's what we do at Phil's Gang. See you on the charts.
Are you nuts?